Good evening, ladies and gentlemen. Um, I'd like to share with you what I call the changing economic landscape of the Philippines. One of the things that we have to remember is that in the last few years there have been greater participation of the emerging markets into the global economies. Um, first there were the BRIC countries, that was Brazil, Russia, India, China. But later on the decade, around 2005, the next 11 was coined by the same person who coined BRIC. This is the Goldman Sachs head of strategy, and he termed the next countries to watch for to be the next 11. And the next 11 included uh, the Philippines. And if you look at the data on why these next 11 are considered to be countries that would be performing quite well over the coming decades, the reason really is because they have large domestic markets. They do not have to be dependent on global economic conditions, because local economic conditions can support domestic economic growth, or GDP growth. The Philippines in particular has 90, the latest census has it at 92 million people, although in the presentation you will see a figure of 94, and a GDP of $225 billion dollars, compared to 189.1 in 2010. So we indeed have gone a long way to expand our domestic economy, and for that reason, uh, there is sound possibility that indeed uh, our engine for growth as a part of the next 11 is actually at work right now. Then there is the Breakout Nations, written by Ruchir Sharma. Fortunately, I had breakfast with Ruchir Sharma last week, and we had discussed um the concept of breakout nations. And well, before he went to Malacanang to have his book signed, we had breakfast, and they explained um, that the Philippines essentially is a breakout nation, um, because it's a country that is beating um, growth expectations. In other words, we were not looking at our country to be having such a breakout in growth. But Mr. Sharma, who incidentally is the head of emerging markets in Morgan Stanley Global Investment Management, he saw this. He mentioned to me that he saw this in the beginning of 2010. He noticed uh, that many people in our country were no longer, shall we say, um, they were not so enthusiastic, because they saw our country as a laggard in Asia, a long history of lagging other economies. In the 50s, 50s and 60s, we were second only to Japan, but the country's economy deteriorated, but we are lagging no longer. As a matter of fact, in the latest economic forecast given by HSBC and Citibank, a long-term forecast over the next 40 years ranks the Philippines as a top growth economy. So given that situation, uh, what are we looking at right now? The chart before you is the growth pattern between 1950 and 2011. That's like a 61-year pattern. If you notice, we had declining growth from 1950 till about uh, the end of the 1980s. All right, so we had a declining growth pattern, and this somewhat bottomed out around 1992. But then again, we did not really have a steady uh, growth pattern. If you look at the chart, we had in 1998 we had negative growth, but we recovered towards the first decade. We had low growth again in 2008 because of the global financial crisis. But lately we are growing above the norm of around 5%, meaning the historical norm of around 5%. The latest figure is 6.4. If you recall, in 2010, the growth figure was 8%. What accounts for this growth in the economy? Well, the next slide shows you the exports. If you notice, the blue bars will give you the total exports of the economy. And in the beginning of the decade, exports were roughly just around the 30 billion level. If you recall, before the century, in the 1990s, exports were way below 30 billion a year. Now we're from 2005 or 2004, we are averaging roughly, or we are exporting above 40 billion a year, except for 2009. Now, if we look at another aspect of source of growth, we see OFW remittances. Now, this chart shows you how it has been since the 1990s. I don't know if many of you will recall, but the OFW phenomenon started around 1977, 78, with the inception of the POEA, Philippine Overseas Employment Authority. And but we have data all the way from 1990. And if you notice, in the 90s, our OFW remittances were barely, well, hardly reached $5 billion, reaching above 5 billion only after 1997, remaining stagnant around that level between 5 to 10 billion up to the year 2004. But look at what happened after 2005, or 2005 onward. It had grown quite rapidly. And what is the significance of this? No? Well, compounded with BPO revenue. Remember that BPO revenue is also dollar based, and the significant movement in the BPO started in 2006. You notice that now BPO earnings is in 2011 is above, well, it's around 11 billion, and with around 15% growth this year, we will see it beyond 12 billion. So both OFW remittances, exports, and BPOs have accounted for the growth of international reserves. If you notice again, from 2000 and before 2005, we had barely 20 billion. As a matter of fact, in the 90s, we had barely 10 billion. But look at what happened after 2005. We breached the 20 billion mark, and we are now approaching the 80 billion mark. As a matter of fact, the latest figure in July has international reserves at around 79 billion. The expectation is that for year end, we might have our GIR above 80 billion, roughly between 83 to 84 billion. Now, what is the significance of all this? Well, in the past, the reason why this country would have uh, uncontrolled inflation was because our scarcest resource was foreign exchange. However, given that foreign exchange is no longer scarce in this country, yes, we still have inflation, but inflation has been running quite low. Inflation has been running, if you look at this slide, inflation has been running in the last few years below 5%, and in this year, it's running at around 3%. And going back to the savings investment gap from the year 1999, we saw our savings increase significantly, and, well, unfortunately, investments have not caught up with savings. And well, if you look at this chart, what this really tells you is that prior to the Asian financial crisis, we were very dependent on foreign capital. But because of the Asian financial crisis and the drought in foreign capital, capital had to be generated internally. And fortunately, we did through exports, through BPO, through OFW remittances, and now we have savings as a proportion to GDP of above 30%, around 32%. Now this places us in the same league as Malaysia, um, and our neighbors. So, what are we um, looking here for? Well, the next chart I will show you a chart of government debt as a percentage of GDP. The yellow bars here, the bars on top would show you the result of OFW remittances and BPO revenues, and I correlated this to government debt as a portion of GDP. If you notice, government debt as a proportion of GDP is now declining. No? And the turning point was at the end of 2004 going into 2005. And if you remember what happened there, that was the passage of the expanded value added tax law. So because of the expanded value added tax law, the government uh, receives more and borrows less, which means we are spending much less for debt service as a proportion of government debt and as a proportion of GDP compared to decades in the past. And as a result, you will see the lower part of the slide. As a result, you will see that interest rates have declined significantly and have been stable at lower levels. And what I'm showing you in the bottom is not so much short-term interest rates, but long-term interest rates, meaning 10-year government securities, which in this slide is only at 5.61, but recently have gone way below 5%. I think 10-year now is only about 4.55. All right. Now, what what is the significance of low interest rates? Well, low interest rates, and I can just point out to the next slide, low interest rates enables businesses or enables government to um, channel resources into businesses, meaning banks can lend at lower interest rates, businessmen can borrow at lower interest rates, and the government can access money at lower interest rates, accelerating growth further. So if we saw a 6.4% growth last year or in the last quarter, we uh, are likely to see similar growth in the quarters to come, given the trajectory of international reserves, of BPO, of W remittances, and of exports. So this growth pattern is likely to be maintained at least for this year, and more likely even next year. As a matter of fact, in the last 3 years, we have um, job creation to be slightly above government targets. If you look at this chart, in the first quarter of '09, employment way exceeded the 1 million target, meaning the new employment generation exceeded the 1 million target. Same thing happened at the end of '09. Slowed down a bit in 2010, but in 2011 we again exceeded new jobs at over 1 million jobs. In the last quarter of last year, it exceeded 2 million new jobs created on a year-to-year basis, and as of the latest figures, we are steady around the 1 million jobs created. So again, growth is really upon us, and we are seeing that in job creation. Of course, job creation um, affects those who are skilled first, meaning those who have college educations, those who have technical education, those who have skills training. So we will see this among more skilled Filipinos. Now, one area that's really seen quite a bit of growth and will probably see continuous growth are tourist arrivals, as you will see in this slide. Prior to the year 2000 and all the way to 2003, we barely had 2 million tourist arrivals. But look at what happened in the years to come. Of course, we had the slight decline in 2008 to 2009 simply because of the global financial crisis. But look, in 2010, it's up 16.7, 2011 up 11.2%, and in the first half of this year, it's already up 14.6. As a matter of fact, that data only takes us to April. So if you go for full year, that'll probably go to about 17, 18%. So growth drivers are uh, exports, BPO, OFW remittance, tourists, and domestic employment. So the domestic economy is growing. No wonder people like Jim O'Neill of the Next 11 concept, um, Ruchir Sharma of the Breakout Nations, and even Citibank and HSBC are all looking at the Philippines as a sustained growth economy for the next years to come. Now, the question is, how about the international scene? What about Spain? What about Italy? What about Greece? Now, these three slides will show you that the risk, the risk inherent to Spain, Italy, and Greece are already manifest in the financial markets. So if you look at here, this slide, it will show you that the risk premium of Germans, of the risk-free German and the Spanish government bond is already at its all-time high and has started to decline. Same thing for Italy, and it is really more dramatic in Greece. In Greece, government spreads hit 35%. What does that mean? You know, when the Philippines had its debt crisis in the 80s, our sovereign debt came to as low as 30 cents to the dollar. In Greece, it went to as low as 8 cents to the dollar. So that is the proportion. Now it's much higher than that. It's about 15, 16 cents to the dollar. So you will see that there's some improvement or there's some dramatic improvement already with the way people assess the Greek risk. Of course, the European situation will be upon us for a few more months, maybe some more years, but there is reason to believe that it has somewhat bottomed out. Okay, so to summarize, we are in a low interest rate regime, and interest rates will remain low. Despite the European crisis, the European zone crisis, long-term interest rates will remain stable at these low levels. There's an abundant fund supply, I showed you earlier. SDAs are around 1.7 trillion. Savings are still greater than investments. In 2012, SDA could reach as high as 2.5 trillion because it continues to grow. Of course, I mentioned the current level. And such abundance in private funds can support private construction and housing, can support PPP projects of the government, and of course, business in general. Now, this is what this slide will tell you where we think long-term interest rates will remain for some time to come. Uh, the short term around 3%, the intermediate term about 4.75. Longer term would be between 5 and 6%. So, what is the outlook and strategy, and why are we making this presentation? Well, the outlook is that domestic fundamentals are strong, intact, and will likely prevail. Interest rates will remain low. Corporate earnings now have room to grow. Why? Because of the robustness of the domestic economy that is also being fueled by exports, BPO and OFW remittances, and tourist arrivals. There's a strong possibility of a credit rating upgrade in the remaining months of this year or maybe next year. PPP implementation will likely create some trajectory uh, th- this this coming months, and will probably help. Well, will probably fuel a little inflation in construction materials and the like. However, uh, oil prices will likely to remain stable, and inflation would be friendly, and it will enhance growth. Now, what is the point to all this? Well, the point to all this is that we hope to um framework your thoughts on how to do your personal investing. With low interest rates, it is not, we have to change our mindset. We cannot merely demand from our banks that they pay us high interest rates because they can't. The market is just not there. It's a time wherein we have to be more creative in how we manage our investments, and we have to be creative in how we set our goals, and what objectives we have to present. Now, going to the indicators, we think, for example, the local stock market is still headed toward uh, 5,500, maybe a little bit further. Corporate earnings in Philippine stocks is hovering around 19%. The stock market is not expensive. It's higher than 14 now. It's closer to 16. The economy likely to grow at 6 to 7%. Inflation to remain stable between 3.5 to 4.5%, and interest rates long term would be about 5.5%. So we really have to change our mindset about how we think about our own enthusiasm about our country. We have a good domestic economy. We have good relationship with our international markets, China situation notwithstanding. And all of this contributes to the view that things have, in fact, changed in the country, in the sense that our long-term growth expectations have to be changed. They have to be revised upwards because that's what the economy is telling us. That's where it's going. And with that, I'd like to thank you for listening tonight. I hope you have a great evening. God bless all of you.